Students, before I start the class, I welcome you all. We all are missing you, and we all are eagerly waiting to see your faces in our classroom. And I hope that we will meet soon. Today's topic is what? A very simple topic is accounting equation. Already we discussed about accounting equation. Today, I just revised the things in a very short way, and that will help you surely to practice this particular concept at your home. So without any delay, let's start. The meaning of accounting equations is very simple. Accounting equation is what? You can say accounting equation is the accounting language. Accounting equation is actually the fundamental principle of double entry system. And you can say that accounting equation is a relation between assets, liabilities, and owner's equity. Very simple, it is said that assets is equal to liability plus capital, where assets mean the future receipts and the properties. What is the future receipt and the properties? Whatever the properties we have, that will be considered as assets, just like building, land, furniture, machines, whatever we are using in the process of production, or whatever we are using in the business as a property. Second is considered as future receipt. What is future receipt? Whatever the amount what business is likely to receive in the future, that is considered as future receipt. For example, suppose you invest money somewhere and you will receive that amount in the future after 5 years. That will be considered your assets. Similarly, suppose you sold the goods to someone with the promise, the person had given a promise to you that I will make the payment after 3 months. So after 3 months, you will receive the payment from that person to whom you sold the goods. So that will be also considered as a future receipt. So very simple. What is assets? In one line, you can say assets is equal to future receipt plus property. Okay, so assets can be a very simple classification. It is future receipts plus your business property. Okay, so future receipt plus property. Now here liability is what? Very simple. Liability can be considered as a one word, future payment. Whatever the business have to make the future payment, whatever the business have to pay in future, that will be considered as future payment. Now here liability will be basically considered as outside liability. What is the meaning of outside liability? Very simple. What is outside liability? Outside liability can be considered the future payment what we have to done the outsiders who is not the part of the business. Like we can see the salaries to the employees, we can see the taxes which we not paid yet, but we have to pay in the future to government. Amount which should be paid in the future, which should be paid in the coming time to our suppliers. Example, suppose I purchased the goods from someone, but I didn't make the payment right now. But I make a promise that after 3 months, I will make the payment. So that will be considered as my future payment, and that will be considered as liability. And this liability belongs to outsider, that's why it will be considered as a outside liability. Now capital, one word is there, that is owner's equity. Whatever the amount the owners invested, whatever the things owners invested for starting or for running the business, that will be considered as a capital. So anything which increase the capital, that will be also included in that, and anything which decrease the capital will also included in that. For example, we will discuss. Okay, so next these are the complete meaning of assets, liabilities, and owner's equity. Okay, so I make it a very simple assets liability, that assets is equal to two words: future receipt plus property. Liability is just a one word: future payment. And owner's equity, you're knowing that right of the owners of the assets of business. In another simple word, you can say whenever a person is invested in money in the business for starting, for running the business, that will be considered as a capital, and anything which affect the capital will be the part of owner's equity. Okay, now what is accounting equation? Now accounting equation already we discussed, that is what assets is equal to liability plus owner's equity. Sometimes assets are missing. So how we can find out? If liabilities amount are given, owner's equity is given, we will add both and we can find out the assets. Suppose sometimes liabilities are missing, so we can just transfer the LHS and RHS and we can make it the formula. So base formula is what? Assets is equal to liability plus capital. But if suppose liability is missing, then what we can do? Assets is equal to minus capital. So liability is equal to assets minus capital. And suppose capital is missing. Suppose capital is missing, then what we can do? Very simple, the similar term, assets minus liability. Okay, so by utilizing this three formula, we can find out the value of any missing figure. Now one question is there, sir, why these two sides are always equal? Assets always equal to liability plus owner's equity. It is basically depend on the double entry principle. Double entry principle says that every transaction affect minimum two parties with equal amount. That's why is both side is always equal. Double entry system. Now what we will do, these are the assets: cash, account receivable, note receivable, land building, equipment, supplies, and machinery. Either you can learn it, either you can keep one simple concept: all future receipt and all properties will be considered as an assets. Now what we can do? Now we are going to solve one question, how accounting equation questions are solved. It will help you to revise all the concept. Just see first question, that what question is exactly. This type of question will come for preparing the accounting equation. These all terms are there. What we have to do exactly? We have to just read the transactions very carefully better, and after that what we have to do? We have to simply find out that what effects are there. When you are solving the accounting equation question, simple thing: what thing is coming in the business, what thing is going out from the business, what if any expenses are there, to what cash is decreased, what expenses are occurred, any future payment is there, any future receipts are there, that we have to find out. And how we can solve the question? Move to solving the question. Now, before solving the accounting equation, you can, this one is optional. Actually, this one is optional, that you can draw this column and you cannot draw this column. That's totally depend on you. You just mention here first, and you can start also, but some teachers are not accepting this, so you can do what? You can simply draw the column, and after that you just go for this one, just write down one, and after that you can write down this whole concept also. This whole concept, it started business with cash. Okay, Sandeep started business with cash. You can write down here. So I'm not writing down, you just write down from that. What we have to do? We have to just write down assets one side, liability plus capital. Now what we have to do? Whatever the assets we have to find out all the assets we have to write down here, and if any liability increase, we have to write down here, and if this particular transaction affect the capital, we have to write down here. Now what thing can affect the capital? Simple, I'm just giving a formula to you. Suppose any drawing will be there, any drawing, any interest on drawing, and any expense, loss, that all will decrease the capital. Okay, drawing is what? When proprietor withdraw the money, withdraw the goods for personal use, that will be considered as drawing. And expenses and losses, you are knowing that. What thing will add? So we will add additional capital. We will add, you can say, any profit, any income, any interest on capital, that will also add. So interest on capital and interest on drawing having a very magical figure, magical treatment. That is actually known as zero effect transaction. It is a very bonus question I'm giving to you. Why it is known as a zero effect transaction? Because interest on capital will be add in capital and minus in capital, and it will cut each other and effect is coming zero. Similar treatment for interest on drawing. So we had already discussed this. Now, how to solve this question? So I'm just clearing all that. So what you have to do, I'm just repeating, you have to write down all the assets here. Any effect in liability, we have to write down here. And what effects come in capital, that one. Now we are solving this question, just a moment. So we just write down here assets is equal to liability plus capital. We can use this as a working note. So number one, you just write down this. In assets, Sandeep started business with cash. What thing is coming in the business? Cash is coming in the business. So we write down here cash. And how much cash is coming? 1 lakh. So we plus 1 lakh rupees in the cash column. In liability, it is 0. And in capital, it will again increase 1 lakh rupees. Okay. So why the capital will increase? But Sandeep started business with cash. So anything which is started, which is invest for starting the business, is known as capital, whether it is cash, whether it is any goods or any assets. So all things will be known as capital. That's why cash will be increased by 1 lakh rupees, and similar effect in capital also increased by 1 lakh rupees. Now second one is purchase furniture for cash. Now you just think that what thing is coming in the business? Furniture. And what thing is going out from the business? Cash. When we purchase the furniture is coming in, and what thing is going out? Cash. So in cash column, minus 5,000 rupees for purchase of furniture. But what thing is coming in the business? Furniture. And furniture is also your property. That's why it will be transferred in the asset side. Furniture. Okay. So furniture is increased by 5,000. Any future payment? No, sir. Any effect on capital? No, because when we purchase the furniture, no profit, no loss is there. So no improvement in the capital. So it will be 0. Now third one is purchase goods for cash. So when we purchase the goods for cash, what thing is going out? Cash. And what thing is coming? Goods. So always remember that goods will be treated as a stock, and stock will be always treated as a cost price. Okay? So I'm just giving a bonus to you that stock will be always treated on the cost price. It will be add also at the cost price, and it will deduct in also at the cost price. So purchase goods for cash 20,000. So our cash is decreased 20,000. Any effect on furniture? No, because no furniture is coming in, no furniture is going out in this third transaction. What thing is coming? Stock. And beta, stock is also our assets. It is also our property. Stock. So stock is also considered as a assets. That's why it will be added in the assets column with the amount of 20,000. No future payment in this transaction also, and no effect on capital, because we purchase the goods for cash of 20,000. No profit, no loss in this transaction. Fourth one, purchase goods on credit. Now it is very important. Purchase goods on credit. We purchase the goods on credit without making the payment of cash. So any effect on cash? No. Any effect on furniture? No. Effect on stock? Yes. We purchase the goods, so goods is coming in the business. So it will be how much better? 36,000 rupees. Any future payment? Yes, this time. And how much it is? 36,000. Purchase goods on credit. We purchase the goods on credit. We have to make the payment of this in the future. It is future payment. That's why it will be considered as a liability, added in the liability column. No profit and no loss in this transaction. Again, that's why in capital it will be 0. Now fifth one. So you just see fifth one. Fifth one is paid for rent 700. So when we are paying the rent, our cash will decrease. So 700 minus from cash. On furniture, effect will be 0. Effect will be 0. On stock, effect will be 0. No future payment because already we make the payment paid for rent. And now when we are paying rent, that will be considered our expense. And expense will be minus from capital. I told you in the beginning only. So capital minus by 700 as an expense. And the last one, sixth one, good costing 40,000, sold at a profit of 24% for cash. So let's proceed to first working note. So working note beta, how much good costing is? 40,000. And how much profit is there? 20%. So how much profit is coming? 8,000. So total profit is 40 plus 8 is equal to 48,000. So mean that goods cost is 40,000. We added 8,000 profit and we sold the goods at 40 plus 8, 48,000. So how much cash is coming in the business? 48,000. Okay. So 48,000 cash is coming. So 48,000 will be added in cash. On furniture beta, effect is 0. On from stock, goods worth rupees 40,000 minus. Why we minus 40,000 only? Because already I told you that good costing 40,000, and from the stock always we adjust, we deduct, we add the cost price only. So here good selling price is 48,000, but good cost price is just 40,000 rupees. So 40,000 minus from stock. Any effect on future payment? So no effect on future payment, but we earn a profit of 8,000. 40,000 goods sold at 48, so we earn a 8,000 profit. So 8,000 profit will be added in the capital. Now you add all that cash, furniture, stock, and capital and liability. And always remember, this is your homework. You can comment, you can pass the answer in your group also, that what answer exactly coming. This one is for you. So what things should be? The LHS side total should be the RHS side, and if both is coming equal, it means you had done the right question. If it is not coming, it means somewhere mistake is there. So you just go through that, see that, and after that solve the question, find out the total and check it by yourself. This is your homework. Okay, so always remember, accounting equation is very easy. Only the things that you have to read the question carefully and you have to find out the effect. If this thing is coming, what thing is going out? If this thing is coming to, if it is a future payment or present payment, it is a cash transaction or credit transaction, it is profit, loss, expense, whatever. If it will be effect on capital, we will add a minus. If it is not effect on capital, we will not touch the capital in that equation. So what you have to do, you have to write down the equation. After that you can solve this one. So this much for today. I hope that will give a little bit revision to you. It will help you. Thank you everyone. Students, before I start the class, I welcome you all. We all are missing you. and we all are eagerly waiting to see your faces in our classroom. And I hope that we will meet soon. Today's topic is what? A very simple topic is accounting equation. Already we discussed about accounting equation. Today, I just revised the things in a very short way. And that will help you surely to practice this particular concept at your home. So without any delay, let's start. The meaning of accounting equations is very simple. Accounting equations